Hello, everyone, and welcome to the first quarterly market commentary of 2025 with information presented by Trilogy Financial's Chief Investment Officer, Mike Serio. I'm Caitlin Spain, our Product Operations Manager out of Denver, Colorado. I'd like to take a moment to acknowledge the fires in California. We realize that many of you on this call are based in California, and our hearts go out to those of you who have been impacted in some way by the fires happening right now. The purpose of today's webinar is to bring you market insights and economic updates powered by Mike Serio. I'll introduce him in just a minute, but quick housekeeping note for you all. We are going to leave some time for questions at the end. We have an email address that we'd like for you to send your questions to during the call. I'll be monitoring that inbox. So if you do send any questions, please send those in to Mike. If you'll go to the next slide, it's called investment.team@trilogyfs.com. And I'll be monitoring that. So please feel free to send your questions there. We'll address those at the end. After the call today, if you continue to have some additional questions, please feel free to reach out to your advisor. If you don't have a financial advisor here at Trilogy, feel free to reach out to the same email address and we'll get you connected to someone. Let me tell you a little bit about Mike before we turn the floor over to him. He's the Chief Investment Officer at Trilogy Capital, and he is responsible for our investment strategy and client communications. He oversees $4 billion in client assets here with us. Over 30 years of Wall Street experience, he has been a portfolio manager, a strategist, and a chief investment officer. Mike has frequently been quoted in the Wall Street Journal, the New York Times, Bloomberg, and the Washington Post, among other publications. He is a former adjunct professor at the University of Denver and at DePaul University as well. He worked on the Russian project for the United States Agency for International Development, where he facilitated the formation of capital markets in the former Soviet Union. He's earned a bachelor's degree in economics from the University of Illinois and an MBA in finance from DePaul University. He's also a CFA, a chartered financial analyst, and a CAIA, a chartered alternative investment analyst. That's a tricky one to say. So with that, Mike, I'll turn it over to you.
Great. Thank you, Caitlin. It's good to be here. As you know, we started this about 3 months ago, and we've had some really good feedback on it. So certainly at the end of this, if you have any questions, if you have any comments, or you do have feedback, let us know. We always love to hear what you have to say. So what do we want to talk about today? Well, we're going to start with a review of the markets, and those are for 2024. It was an exceptional year. I'll go into some of our macroeconomic thoughts, doing the best I can to make some obtuse things understandable. We're going to talk about the equity market, the stock market, where the opportunities lie and don't lie. We'll talk about the bond market for a second. And then we're going to give you time to ask some questions live. Certainly, there's a couple of ways to do it, as Caitlin said. One would be to email into that address here. It's again investment.team@trilogyfs.com. So let's get to it and start with the review of the equity markets. As you probably know, we've had 2 incredible years in a row, both over 20%, which is not something that happens very often. Last year, we had 57 record highs, which is the most since 1957. It distinguished itself from other equity markets we've seen in the past by just a few issues leading the way. And we only jokingly call them the Magnificent Seven or the Magnificent Eight, depending on how many stocks you want to put in there. The S&P Mid-Cap Index, which are a little smaller stocks, returned not quite what the big guys did, but almost 14%. Small cap 11.5%, and where the weaknesses were around the world was everything non-US. So we look at that 2 ways. We have developed international, which would be Europe, Australia, and the Far East. That was up only about 4.3%. And then emerging markets, which is dominated by China, Brazil, Argentina, et al. That was up only 8%. As for the bond market, not a great year for the bond market. Part of that is the first half of the year, there was Fed tightening. As we may know, that when rates rise, bonds don't do well. And you can see the U.S. Aggregate Index, which is an index of all the bonds out there in the United States was only up 1.25. Government bonds only up about 62 basis points. Remember, 1 basis point is 1/100th of a percent. And then the muni bond market up about 1%. So what I want to do is take last year's equity market, stock market, and put it on a scale. And let's take a look at what it had done in previous years. You'll see up there I'd circled 2024 again about 25%. And what's interesting, you'll see 2023 right under it. Our feelings are that, and we'll go into this in a little bit more detail, but going forward, equities still look somewhat attractive, certainly not as attractive as they had been when they were on sale, both during the COVID crisis and what we saw in 2022, where the Fed reversed course. We had some bad inflation numbers and they tightened quite a bit, which was not good for stocks or bonds. When we take this back a little further, one less observation here, and it's kind of interesting. We almost have 100 years post depression, Great Depression in the United States. So we usually start with our charts back in 1928, but it's kind of interesting when you just eyeball the chart, you'll see what we call the left tail, or the bad events is much longer than the right tail, which are the good events. That goes back to something we call behavioral finance, saying that people in markets hate bad news and losing money much more than they like good news and making money. So you can see some of that left tail, some really bad stock market events. If you just studied this chart, you would see that those are absolutely the best time to buy because a lot of those really bad years are followed by the right tail with really good years. But putting this on a little broader perspective, you can see this is an interesting one I dug up a couple of weeks ago, that about the first 12 years of the century, market didn't do anything. We went through two crisis situations. It would be the first one starting in and around March 2000. We had 9/11, we had a war, we had a recession, and then the great financial crisis of 2008, 2009. But you can see that somebody flipped a switch in and around 2012, and we've had tremendous market returns since then, up well over 1,000%. And this just goes to the fact that timing the market is extremely difficult to do. If you have a commitment to equities and growth assets, you should stay with them because the market can make up for 5, 6, 7 years of bad returns very, very quickly, which is why I thought this one was interesting to everybody. But let's get back to last year's market, and you can see the weight of just 3 stocks, and that would be Apple, Nvidia, and Microsoft across some of these indices, and that's the S&P 500 there in the black line below. You can see that just these 3 stocks composed about 21% of that index, and then the rest of the 497 was the rest of the index. So it was obvious that these 3 plus a handful of others really drove that market last year. And anybody who made a bet against those 3, possibly on valuation concerns, didn't do very well at all because the equal weighted index significantly underperformed what we call the cap weighted index, which ranks the bigger stocks as a larger percentage of return. So if you look why you wouldn't go in there, one reason would be valuation. Now there's a number of different ways to value equities. One would be, you'll see at the top, enterprise value versus sales. You'll see price book, price sales, and you can see that all of these measures are way to the right side, meaning that this is not a cheap stock market. But I'll warn you that valuation is not a good timing tool because markets can stay undervalued or overvalued for considerable amounts of time. But I will tell you, as some of my best investments in the 30 plus years I've been doing this have been on what we call on the cheap. And some of my worst investments have been on the cheap too, because sometimes things are cheap for a reason. But just to conclude here, that the market certainly is not cheap right now. But one reason I want to point this out is, again, that red line here on this chart looks at profit margins, and that's the red line of profit margins of what we call that mega cap 8. Again, those top 8 stocks, including Alphabet, Tesla, Nvidia, Netflix, et al. You can see those companies are the driver of earnings growth, having over 25% profit margins as a group. And if you compare that with the S&P 500, you can see down there, it's just about 13%. So those are the stocks that are driving the market, but those are the stocks that are certainly punching above their weight when it comes to selling things and contributing to earnings for the stock market. Now, when we look at these things, longer term, there are 3 ways to grow your economy. The first one is hours worked. And in the United States, we're already some of the hardest working people on the planet, believe it or not. So we're not going to have an increase in hours worked. We do need more people. And whether, I want to be apolitical here, but immigration is actually extremely important for this country because there are jobs we need to fill. There was a jobs gap, a lot more jobs available than there were people to fill it. And immigration actually filled up that jobs gap. But the next thing you're going to need, which we believe will be the driver of prices going forward, is something called productivity, is how productive you are with the amount of assets you've had. Now, if you look in history, there's a number of different things that led to productivity explosions. You'll see the IBM mainframe back in the 60s. You'll see the advent of the personal computer in the 80s. You'll see the internet in and around 1995 when Netscape became public. That really helped productivity, and everybody going forward had a PC on their desk. Now it is artificial intelligence. And if you look what the simple ChatGPT 3 does, now this is an early version of what AI will become. And it's not just the providers of AI, the NVIDIAs of the world and the companies giving us the infrastructure here, but it's going to be the beneficiaries of AI. And what we've seen in history tells us in explosions like this in productivity, it's shorter term, it's usually overvalued and a little hype, but longer term, you're going to have just about every company out there, including Trilogy Financial, using artificial intelligence to make their company that much more effective. So we're going to talk a little bit more about that. I'm going to tell you how we're taking advantage of that in some of our tactical portfolios. Now, one of the things we are backing away from going forward are international investments. And unfortunately, when you see a revolution like we are in AI, it is technology. Now, what usually happens, and we saw this back in the late 90s, is for every Google you have, every Tesla you have, every great company we got out of there, probably there were over 100 companies that tried to do it and that failed. And that's what we call creative destruction, is you put a company together, you try your best to take over Microsoft or IBM or somebody. It doesn't work. You let those assets go to other areas. And unfortunately, in technology, those assets are people. When you look at what's happening in Europe, given their somewhat socialistic society, it's much harder to fire people than it is to hire people. So that the framework of what they're doing just does not lend itself to great technology investing. And if you take a look here, you'll see 10-year average earnings since about 2015 of both emerging markets and developed, that's that Europe, Australia, and the Far East, ex-US, those earnings have been flat. And they've been flat now for about 9 years. On the other hand, you can see the black line, that's United States earnings, and have again exploded to the upside. And that has just been great for our market, causing us in your portfolios to start underweighting international investments just a bit. Second problem they have is actually a baby problem. As I said, you need more people if you're going to grow your economy along with hours worked and productivity. And you can get more people one of two ways. You can have immigration or you can have babies. And if you take a look here, and this is by the Financial Times, is that organically, at least Western Europe is getting smaller. You can see that a statistician will tell you you're going to need about 2.1 babies per family, and that just makes up for people who don't get married, just as replacement level for your population. And you can see here, France, the entire EU, Germany, Finland, Italy are not replacing the people who pass away. They call economics a dismal science, and this is one way to look at it, is certainly they need more people out there to start expanding their economy. The other thing I want to talk about here is China. As early as 2015, China was supposed to overtake the United States as the world's biggest economy. Certainly, they're many times the size that we are if measured by people. But you can see estimates starting in 2019 and then estimates last year in 2024 are telling us that given China's demographic problem, they're again a country that's not getting bigger population-wise, they're getting smaller. There's probably a chance that they won't surpass us for another 10 or 20 years. This is again causing us to underweight China in our portfolios. And again, with the tariff issues, I'll talk about that in a second, probably not a place to have a good deal of your assets. And although there are companies there that are going to do very well, which is why in the area we're going to stay in active management, not just passive management. So some of the opportunities we see out there are going to start with infrastructure. And if you take a look at this chart, this is the growth in infrastructure. You'll see the percent change from year to year in what we call non-residential structures, which are manufacturing and non-residential equipment. So here are some things we have significantly underinvested over the last 2 or 3 years. And as we see the potential tariffs going out there, the deglobalization of the United States and the world, and we're going to start producing more and more things at home here. This gives us an opportunity to invest in some areas that are going to increase the infrastructure in the United States. Another thing we're looking hard at are homes. As you all probably know, home prices are absolutely through the roof, just about anywhere out there. And there's two main reasons. The first one is that mortgages were so cheap for about 10 or 12 years when we had what we called zero interest rate policy, when you could take out 30-year money for 2.5% to 3.5%. Those mortgages now are worth a lot of money for people who own those mortgages. And certainly it takes a lot for people to move if they have to refinance with now 6% or 7% money. The second investment opportunity here is there just are not enough homes in the United States. So the home builders look quite attractive to us. So we're going to be looking at both non-residential and residential infrastructure going forward. So let me, to the extent we can, make some predictions on the market. I'm going to give these to you with a grain of salt because I'm going to show you on the next slide how difficult predicting these things are. But we look at it right now as we sit here January 13th, there's a good probability that there will be no recession. And a good probability means about 75, 80% probability. Recessions, if you take a look at just some average arithmetic, coming in around once every 7 years. It doesn't look like it right now as we sit, but there's always some exogenous factors we see. But this bull market is now almost about 2.5, 3 years old. We're up about 67%. As we see in history, bull markets like this do very well in year 1 and year 2. Doesn't necessarily mean we're going to have a negative year in year 3, but probably look for a little more muted returns this year. We believe the Fed will continue with their rate cuts. We got some strong economic numbers, employment numbers last Friday. So expectations now are down from about 7 or 8 cuts next year to about 2. When I say next year, it's 2025. Market returns historically are positive when the Fed starts cutting rates. So we have a little bit more of that 12 months left over. So again, we still continue to be somewhat bullish on the stock market. We do believe this will depend on earnings, and not just earnings of that magnificent eight, but a broader stock market earnings. And we're going to need those earnings to come in, given the valuation levels we're at, to get some stronger stock market performance. And then the big wild cards here are fiscal, is what the government's going to do to inject liquidity into the economy. As soon in about a month, we have a debt ceiling issue, but we know that Treasury's general account has a lot of liquidity they can inject into the system. One of our research partners said this could be a bazooka type event. So that could be really good for stocks. Obviously, trade's important, and to the extent the new administration is just using tariffs as a bargaining chip, or if they actually mean they're going to put on these type of tariffs with our trade partners. And the good thing with the new administration is actually, Caitlin talked about the fires in California. Regulation and over-regulation stifles growth. And what we're seeing with some of those fires is the Coastal Commission to start rebuilding Malibu, and the areas out there are going to start dropping regulations so we can get some trade and commerce going there and rebuilding their homes. I talked about having forecasts and how inaccurate they are. And if anybody thinks they could accurately forecast markets going forward, you can't. So this was just, I think I got this off in The Economist as of December 27th of last month. So just a couple of weeks ago, you can see some of the top firms, research firms in our business, and their forecast going forward, anywhere from S&P 6400 to S&P 7100. But I thought it was interesting, as the article said, over the last 24 years, forecasters' price targets have actually missed the mark by about 14% on average. So if you actually think you can forecast market returns, good luck to you, because you just can't. Let's get to bonds now. Couple words on bonds. One, the municipal market, I think we have to really look at hard. This is an interesting chart talking about where in the United States people are moving from and where they're moving to. You can see, and I'm not going to go on a limb here, but with high taxes, high regulation, and other things, California, New York, Illinois, and New Jersey are losing a substantial, not just amount of people, but amount of wealth. And that wealth means taxes, and those taxes go for obviously essential services at all, which back municipal bonds. So we are seeing migration from those states on the left to the states on the right, meaning Arizona, Texas, and Florida, looking much better, and wealth moving there because of lower taxes. And it's kind of funny sometimes. The government actually, by lowering the tax rate, gets more tax revenue because more people migrate to that state. So that's a little word on municipal bonds. I'll talk a little bit about the bond market in general and a little history. So if we go back, and there's a really good book called The Great Inflation and Its Aftermath. It talks about the inflation we country experienced back starting in and around 1963, when a new administration came in, trying to enact something called the Great Society, and started deficit spending there, and spending more money that they had. And Milton Friedman, as I mentioned on the last quarter, who's my favorite debt economist, said inflation is strictly a monetary phenomenon. That's too much money chasing too few goods. And when you have that much money into the system, inflation rises to the point to where we had in the early 80s. Some of us here can probably still remember 18% mortgage rates, 16% 10-year bond rates, and so forth, until that administration put us into a nasty recession, actually a double dip recession. And the fortunate outcome is it led to about 40 years of prosperity with lower inflation, what we call disinflation, not deflation, but disinflation is inflation falling. and lower rates, which made homes much more affordable, which was great for the economy, so forth, up until about 2022. And so the big question here is that, is this going to happen again, and will history repeat itself? So you can see on the right side that that black chart, those are interest rates are starting to go up again. And I think what disappoints us that study economics is this was not a big subject in this election, but I'm certainly going to hope it gets some more play here, because if you look at the amount of money we've been spending, and this is the time required to reach total U.S. debt levels, the first 10 trillion of debt levels in the United States took 232 years. And you can see we've been adding a trillion every, call it 8, 3, 3, and 7 months. So the amount of debt outstanding is amazing. The amount of money we're spending is just off the charts right now. And I don't think, I hope people understand this, that we are now spending more in interest on this debt than we are on defense. And we're not spending our money, we're not spending our kids' money, we're actually spending our grandparents' money right now. And this is the thing that worries me the most. There's a couple ways we can get out of it. We can inflate our way out of it, which is not a good way to do it. We don't want to have to go through the inflation that we experienced in the late 70s, early 80s. We are hoping, if there's a bright light here, is that AI productivity will enable us to get our economy growing to possibly a 2.5, 3, 3.5, maybe even a 4% growth rate, so we can grow our way out of it, which is a real positive. Okay, let's finish up with some of our base cases here. Here's our economic base case. Presently, we are in soft landing territory. You might have heard the term Goldilocks, not too hot, not too soft. We think that theme remains in place. Immigration has helped on the inflation front, and we certainly hope there isn't mass deportations. We're going to need some labor to go rebuild California. Unemployment, however, has been slowly rising, not to the extent where it worries us right now, but certainly we're keeping an eye on it. Talked about the Fed probably only cutting twice in 2025 right now, but we're keeping an eye on the inflation numbers, as that a lot of times these inflation waves come in second and third waves, and it looks like we got through the first one, but we're cognizant that there could be another wave of inflation happening. Talked about productivity enhancements via AI. And then the tax code is very important, as these tax changes that were enacted in 2017 are scheduled to sunset at the end of 2025. Given the results of the election, we can probably see these things being extended because if you look at where some of these taxpayers are sitting, and depending on what tax bracket you're in, you could see as much as a 20% rise in your federal taxes going forward. In equities, again, we favor U.S. markets over foreign. We like growth stocks, companies that have the ability to grow their earnings much quicker than the average. We favor those slightly over value. Again, we're going to stay with larger companies, as smaller companies have some headwinds out there. And then in our tactical portfolios, we have three main themes. These themes are more midterm themes that may take a couple years to play out, but that would be artificial intelligence, as we discussed, not just the innovators, but the beneficiaries. Utilities. I bet people don't know that when they do a ChatGPT query, it takes about 10 times the amount of energy than a Google query does. So for the first time in my career, there's actually a great business case for utilities. We usually thought of utilities as dividend payers and hedges against market downdrafts, but there is a really good business case now for investing in utilities. Industrials, I talked about the deglobalization of the world. That seems to be an interesting part we want to get in. And again, if the government keeps spending the way they are, interest rates have no place to go up, but up. But we're looking at self-funding corporations, those companies that are strong enough to not have to access the capital markets and not have to be at the mercy of interest rates. So that's where some of our longer-term tactical ideas are being carried out. Okay, fixed income. Doesn't look all that exciting right now. Let's stay with quality. You're not getting paid to go into lower quality, lower rated corporates or even high yield bonds. We're staying nimble. These markets could be volatile. I said there's probably 2 rate cuts baked in, but that's subject to revision. But the good thing is when we have bonds here and you want to take a look at the 10-year government bond, it's yielding about 4.7% right now, is it's still a good hedge for your stock portfolio. And, as you know, not a lot of our clients are all stocks, not a lot of them are all bonds. Through the planning process, we want to make sure we have a portfolio that meets your return requirements and risk constraints. And so when we do that, we hedge out the stock market risk with bonds, and with the bond markets now paying a decent return, the efficacy of bonds is pretty good right now. In the alternative space, okay, I'm just going to take a couple words about this because we have our Tactical Plus portfolios being rolled out. We like 3 areas. The first one is income producing real estate. As I mentioned, there's a shortage of houses out there, and income producing real estate looks like a good place to be, given that at the end of the day, people have to live somewhere. We like private credit. It looks like the government continues to, quote, utilitize banks, making it harder to write loans, and a lot of those loans are being done by the private sector. Again, we like infrastructure longer term, and then what we call middle market private equity. Caitlin, let me end up here. As you know, if you've heard me, what I've in the 30 years I've been doing this, what I always have noticed is optimistic people, happier people make way more money than pessimistic people who are always worried about what if, what if, what if. So I always try to end up with some good news. And this is something, a database I've been using for a while. It looks at, I picked out 4 things here. Number one, child mortality. This goes from 1751 to a couple years ago. It's never been lower than it's been now. You look at literacy rate on the one below that. It's never been higher than it is right now. It's actually never been better to be alive if you look at everything than it is right now. Life expectancy at all-time highs. And there was this guy, you may have heard about him, named Malthus, who published about 150 years ago that said we were all supposed to be dead now because we couldn't keep the food supply up with the population growth. But if you take a look at the lower right, yields of staple crops worldwide have never been higher than they are right now. So those are a couple reasons to be optimistic. And let me end up before questions here, thanking everybody. My favorite quote kind of all time is, attention is the rarest and purest form of generosity. And we want to thank you for your attention and your generosity and certainly your business. So let me kick it back to you, Caitlin, and see what kind of questions we have.
Thanks, Mike. Always appreciate your in-depth explanations of how all of these things are interconnected. It's really important. We have a couple of really great questions. So you talked a little bit about mortgage rates and even real estate in some of Trilogy's portfolios. Obviously, mortgage rates are something that's on everyone's mind right now, whether you're a home buyer or a real estate investor. Can you talk a little bit about and share your thoughts on what we might see with mortgage rates for 2025?
Sure. We told people there was about a 10-year period where the United States went under something called ZIRP, or zero interest rate policy, where they artificially lowered rates to the extent they could to get the economy going. There was no better time to be in real estate right then, when you were getting 30-year money at, call it 2.5%, 3.5% rates. As I mentioned, part of the reason the housing market is slow because those mortgages are worth a lot to the people who have them. But I would say, and when you talk to your advisor in the planning process, even if you're paying 6.5%, 7%, and you do that, put that in your plan, and you can afford that, you might want to think about going a little longer, maybe a 15-year mortgage, maybe a 30-year mortgage, for the simple fact that you know what that payment's going to be. And if in fact the government continues spending the way they are and we get to back to double-digit mortgage rates, you'll still be happy you have a 6.5% mortgage.
That kind of leads to the next thing, which is regarding the debt ceiling issue that you mentioned earlier
Mhm.
and the level of outstanding debt, the challenges with that. What are the impacts to us as individuals?
Well, it's something that we've been talking about for a long time. It's called crowding out. So when you look at the government's appetite for debt, in order to entice people to buy their debt, it's simply supply and demand. They're just going to have to raise the interest rate they're paying on that debt. So people around the world, and people around the world are still buying our debt. About 20% of every auction is taken down by either China or Japan. They're now competing with the private sector. So if I'm a business owner and I want to go to the bank, or I want to go to those uh, other places to get a loan, if the government's taking all the money because they need it, and they're raising interest rates to the point where a business owner can't afford the amount of debt, they're going to have to go other places to get money. That's something we called crowding out, and that's when it gets kind of dangerous, when you start crowding out private businesses and the government's, taking everything they can.
Thanks, Mike. We've got some time for some more questions. So I have a couple more here. As a reminder, if you do have any questions that you'd like us to discuss today, please feel free to email investment.team@trilogyfs.com and we'll bring your questions into the discussion. Mike, a good question here around leading and lagging sections of the market or economy. So, what are some areas that we might expect to see or would hope to see leading this year versus what might we see as a lagging sector?
That's really good. That's a really good question. So right now in our tactical portfolios, again, we are having utilities as a leading sector. And again, it's not just for interest rates, it's from the business case. We also like industrials. Again, property, plant, and equipment needs to be added. Some of the things that we're a little hazy on right now that we are underweighted is, believe it or not, healthcare. And you would think healthcare demographically in the United States would be great, and it certainly is. But we get worried that the boomers are more and more going to Medicare, Medicaid, and then reimbursement rates for Medicare, Medicaid are not where, the market had anticipated. So healthcare probably, and given the new administration, we're a little hazy on what those rules are going to be. So we're underweighting healthcare for a bit. Energies, at least the first couple weeks of the year, has been strong. But I would look for energy to possibly be a laggard. And when we say energy, that would be upstream. Those would be the people, oil and gas exploration companies. What they like for them to do well are high prices. And to get high prices, you don't need a lot of capital. You want less capital expenditures. And right now, there's a lot of capital going into that market. So upstream doesn't look very good. What we call downstream, which is like the toll booth, which depends on volume, actually looks pretty good right now. So just in a nutshell, those are a couple sectors we're commenting on right now.
Thanks. You kind of wrapped some of this into your previous answers, but can you lay out some ideas around what are the biggest risks out there right now?
Right now, the biggest risk is geopolitical. There's always, you look at China's aggressiveness towards Taiwan, and I know we're trying to build as many what we call fabs, or fabricating plants, for semiconductors back to the United States, but we still rely significantly on companies like Taiwan Semiconductor. Taiwan's a small island. China's a huge place, and if they decide to go across the straits, that would be a risk. Certainly, what's happening in the Middle East has always been there. It's been there for 75 years, or even thousands of years, depending on how you look at it. That's going to be an issue. But that's the biggest risk out there, along with some of the other ones we talked about, mainly with the government's appetite for debt and rising interest rates.
Regarding the geopolitical risk, one of the things that we've seen a lot recently about is potential tariffs for Canada and Mexico. What are
Yeah.
some of the impacts that we might see there?
Well, I hope this administration is just using that as a negotiation ploy. And it's kind of interesting. Caitlin mentioned I was a professor at DePaul where I taught economics, and I may have talked about this on the last call. But one of the things is something called comparative advantage. And the example I always use was Brazil and the United States. Brazil is great at growing coffee. Uh, we're not very good. We don't have the land. We don't have the things needed to grow coffee. We're great at technology. Brazil's not very good at technology. So if we trade technology for coffee beans, that's a situation where 2 + 2 = 5. And because they have a comparative advantage growing coffee, we have a comparative advantage in technology. Now, when you start putting trade barriers up in the form of tariffs, any free market economist will tell you that's not a good thing because that's raising the cost of living for people in the United States that buy coffee, that buy Chinese produced goods at all. And where's that money going to? Well, it's not going to anywhere productive, it's going to the government. So I'm hoping, and we are hoping as a group, that this administration is using tariffs as just a bargaining chip, and we hope they use it surgically at best and not worldwide.
Thanks for your thoughts on that. We have another question regarding resources for learning more about the markets and the economy. So if someone uh, is interested themselves, or maybe has a teenager or a young
Mhm.
young adult child learning about the market and the economy, what kinds of books or podcasts or other sorts of
Yeah,
resources might you recommend for them?
there's some classic books out there, and rather than giving you the name of the books, I'm going to give you the name of the authors. Professor at Wharton named Jeremy Siegel wrote a book, Stocks for the Long Run. He has a number of other issues out there. Read everything you can from Jeremy Siegel. A guy by the name of Peter Bernstein wrote some tremendous books. One's called The Power of Gold. The other one is called Against the Gods, which is the story of risk. If you really want to go back to Egyptian times and learn about risk, anything by Warren Buffett or anything by Benjamin Graham. Those are all great books. On the planning side, and I talk to our advisors a lot because you can't invest money without a plan. And so when we do a plan, that's very important. But there's a great book I read a long time ago, Rich Dad, Poor Dad, which tells you how to be a steward of your own money and a steward of other people's money. And it's a really good book. So those are some great resources. If you have questions, you want to go a little farther, talk to your advisor and we can give you some more titles.
I read Rich Dad, Poor Dad as well, and would definitely recommend it.
Yeah.
Perfect. Well, to make sure that we wrap up on time, that's going to be it for Q&A today. But thank you all for your questions. Thank you for reaching out. As a reminder, if you have any questions after the call today, please feel free to reach out to your advisor. And if you don't have an advisor, reach out to the email that we've put up on the screen at the beginning of the call, which is investment.team@trilogyfs.com. Reach out to Mike, reach out to me. We're happy to help, happy to guide you on as you work toward reaching your financial goals. These calls happen quarterly. So as a reminder, our next session is Monday, April 14th at 1:15 p.m. Pacific time. Thank you again for being here. We're grateful for your time and we hope that you've learned something. Enjoy the rest of your day.
Thank you.